Okay, well, let's welcome in Nimesh Chandan, who is now with us of Bajaj Finserv Asset Management. Nimesh, welcome back to the program. Thank you very much for your time. Prashant this side. The common refrain is that it's a little bit confusing because markets have done so well. What next? We're at that stage where flows are unrelenting, but people are also kind of struggling to find newer ideas. You've been kind of maintaining for the last couple of months that one needs to be a bit contrarian now, right? You've advocated large caps over mid and small caps. You've kind of said look at sectors which perhaps investors have ignored, although there's very few there. But I think you've highlighted chemicals, CRAMS potentially. Just sort of what's the lay of the land to your mind now in terms of where we are? Because we are coming off a bit of a sort of volatility as well, which was quickly put back behind and the markets moved on. Although it looks like in many sectors, momentum is kind of broken. You look at what's happening with PSU defense, for example, that one-way trajectory seems to be at least taking a halt. It's just been 1 week, so maybe I'm speaking too early, but what are your thoughts?
Hi, Prashant. Always good to be on the show. Well, the view is the same, actually. So if you want a cautious voice towards the market end, I am it. So the view is the same, that markets have re-rated quite a bit in the last 2 years, especially the mid-cap and small-cap space. So risk-reward seems better in large caps currently compared to small and mid. Also, a lot of the glamour stocks or hot stocks and favorite themes have now reached valuation where people will take some pause to reassess the situation, see execution of order books in some of the sectors, see how, in this year and next year, how the progress is to what the narrative has been in the last 2 years. So we've given the valuation. Now we are waiting for execution in many of these sectors. Clearly, in this result season, you would have seen that companies, especially in mid-cap and small-cap, if they are not meeting their expectations or not able to, cater to the huge demand of numbers that people have, those stocks are falling very sharply and correcting a lot. And yes, it is the right time to look at valuations, and hence contrarian approach is important. We like overall the space, consumption and pharmaceuticals. In terms of the contrarian bet, yes, last time also on your show, I said chemicals. In this year, chemicals, we will see good volume growth. We are waiting to see some price action also by the end of the year. And many of them have re-rated since the first time I came on your show in the beginning of the year, when I said this is a good opportunity to look at them. And overall favorable for domestic more than international. Some of the international business, I'm very cautious.
So IT is an avoid for you in the international business. And how else have you positioned your portfolio for this caution that's evident in your voice? Have you upped your cash levels or paused fresh investments or at least brought them down?
Yeah, so interesting thing is we don't take cash calls. What we do is we move to areas where we find more of a defensive growth or defensive valuation. So, as I said, pharma and consumer are suddenly the areas where the growth is quite good and the businesses are defensive and the valuations are attractive. So this comes as a very good package for us. So moving from, say, a very capex-oriented portfolio in the last year, we have moved in the last few months towards pharma and consumer. So those would be a high overweights. Definitely, we are a bit cautious on IT, and so we are underweight on IT, and we have maintained this underweight for last 1 year now. See, these are B2B businesses. If the client sees some slowdown in their geography and some pressure on the business, there could be some pressure on these businesses too. Growth rates are slow, although now I think for the next 2 years, even the Nifty growth rate, profit growth rates are going to be a little slower than what we have seen last 2 years. So we are a bit cautious because we are watching the scene internationally, how it unfolds. Looks like the slowdown will be more protracted, and that means there could be some disappointments going forward with external facing companies.
Hi Nimesh, good afternoon, and this is Nigel on this side. Good to have you on the show. Nimesh, I wanted your view on the metal stocks. You know, a few months ago, everyone was going gaga about it. People were telling me about the good use of copper, zinc, silver, all sort of that. And, you know, when the street gets a consensus buy call, that's when the bad news comes in. Some of these stocks have corrected 20-22% odd from the peak. And stocks like Hindustan Copper are down 30% from the peak. When you see here too much of pessimism that's
Nigel.
coming in there?
You are absolutely right, Nigel. A few months back, there was a lot of excitement about commodities. Maybe some recovery from the bottom was seen, but it looked like a very short-lived recovery. Surprisingly, so you've touched upon a very interesting point. Surprisingly, in the last couple of months, we've seen that not only metals, but also soft commodities have corrected sharply. So you see internationally wheat, corn, soybean, all these commodities along with tin, copper, zinc, they are either at their 52-week low or some of these commodities are at like 5-year lows. And that shows that there is some risk off and caution within commodity markets. So the commodity markets are signaling that they are preparing for a sharp slowdown globally, and they are not expecting the global capex to be great. And I think equities should take that signal and be a little cautious about these external facing sectors.
Okay. Nimesh, hi. So, you know, overall, what's the sense that you get from the markets at this point in time? Of course, domestic investors have learned to buy each and every dip, and money's coming in every single month, every step of the way. But could there be a possibility that we get into a period of more tempered return, something that especially, you know, newer investors have perhaps not seen? I mean, overall on the market, what would your expectation be from, say, the next 12-month perspective?
I think patient capital is what will win. So ultimately, patient capital, which is looking at good returns, participating in the India growth story, having a minimum investment horizon of 3 years, I don't think that there is any worry for those investors. Obviously, portfolios, depending on where the valuation and the growth gaps are there, will shift there. See, last couple of years have given quick profits and almost like, you know, broad market has gone up. So everybody thinks that we will see very high returns and quick returns in equity markets. I think that's going to, those people are going to be disappointed. Markets now our bull rally will continue, but bull rally will have its corrections. It may have a flat movement for some time. And certain areas where expectations are high, valuations are high, even a small disappointment is leading to a sharp fall. So it is time to be patient. It's not time to be negative or not bearish, but it's time to be patient and have some realistic expectations. India is on a very strong journey, the corporate sector, the economy, on a very strong footing. But it just requires patient capital to make money.
Nimesh, what about these new age tech companies? The investor appetite for new age tech companies has gone up over the last couple of months. Some of them have shown the profit potential, like a Zomato. Look at yesterday's listing, First Cry, 50% up on day one. Ola Electric has had a pretty dream debut. Are you comfortable buying any of these new age tech companies?
Definitely, many of these companies have shown good numbers. So people are rewarding them for the good numbers that they are doing. Some of the business models have really delivered good returns. So they are getting rewarded, and we've seen them move up by about 100% to 150%. Among the new listings also, we've seen a good debut for many of those. However, I always get a little worried when people start generalizing on things like whether it is new age tech companies or PSUs. Whenever people generalize, they pay the wrong price. So not all businesses deserve a high valuation because they are in a particular category. You have to go business by business. I know this is a very boring answer, but it is true that you have to look at each business on its merit. And just because something is a new tech doesn't mean you give it high valuation. Concepts do get higher valuation because they come with a certain promise or a narrative. But ultimately, if the business model is good, the execution is good, they sustain their valuations. Otherwise, the others don't.
So to round this off, Nimesh, let me ask you to get more specific, right? You're right. I mean, new age companies as a basket is a very wide, sort of a selection of businesses. So leave us with the new age themes that you think have serious wealth creation potential if the companies play it right? I mean, is it EV that you'll look at more closely? Would you look at consumer technology? I mean, that could include companies like a Nykaa or a Swiggy or a Zomato, or could it be something else? So, I mean, maybe some of the more innovative companies in the pharma research space. So, leave us with the one or two of these new themes which you think investors must analyze for medium-term wealth creation.
I'll try to dissect it or put as micro as possible. So within pharmaceutical, definitely an exciting area is contract research and contract drug development. And we will see increasing inquiries with pharma companies in this area and increasing order book for them. We are quite excited about that space. Within consumer, think about lifestyle consumer. India is growing well. We are seeing per capita income rise. So who are the beneficiaries of this premiumization, this upgrades? Those are the companies to look at as the lifestyle plays or premiumization plays within the consumer basket. Within tech, obviously, we are a little more selective, but go with companies now which are executing well. There is a good story behind them. We need to see good execution. We need to see good monetization. It is not just about having huge losses now. It is about making some money. You should have a product or service whether if it's so good, the customer should allow you to make 1 rupee profit at least on that. So look at those profitable companies and see who's executing the idea well. Having just a concept.
I think we lost the line there with Nimesh. But yeah, point taken, Nimesh. If you can hear me, thank you very much for joining us and running us through that perspective. Caution on the table. And I think it's kind of well taken. Even though people have gotten used to an up-and-up kind of market, it's important once in a while, at least, to put some of that on board. That's not the usual state of affairs. We've been in an extraordinary time period over the last couple of years. All right, we'll take a quick commercial break here.